Hello, it is Tuesday the 10th of December and we are an hour out from CPI inflation data, and tomorrow we have PPI inflation data, which is all ahead of the Fed meeting next Wednesday and rate decision. At the moment, I think the market is pretty certain that the Fed is going to continue to cut rates next month, but higher than expected inflation data today and tomorrow kind of takes the pressure off the Fed to cut next month and maybe wait until the new administration in government come in. I don't really feel like this inflation data is that important at the moment with everything else that is going on in the world. I am more worried. At the moment, the market has pretty much priced in no landing. So we went from a hard landing and going to have a recession to a soft landing and a super mild recession to pretty much the market is now, the way stuff is trading, pricing in no landing at all, or certainly for stock indexes, no landing at all. So that means that any kind of weakness in other data like the jobs market or housing is likely to me to be the surprise outlier move. And so I actually think that this inflation data and what the Fed do next week is less important, for example, than the jobs news coming in and non-farm payrolls on the 3rd of January. And it's very common price action in December to see very choppy sideways and pretty much a continuation of the trend leading into December. And if we're going to see a reversal or bigger moves or trendy moves, they tend to come in January. And so far, the market hasn't disappointed. Yesterday, the S&P fell 0.5%, and you'd think the world was ending. And so it is going to get a little bit choppy and volatile. So what about this CPI report? Again, if it comes in stronger than expected, inflation not falling as the market is anticipating, I think that will be a kind of bad news is good news. The Fed won't cut. I just think that this increases the volatility, and so how the market reacts actually is more important than what the data is. A little bit of a choppy pullback here sets us up pretty nicely. So if we do get a bit of a bigger pullback, I think it sets us up really nicely for a month-end Santa rally. If we continue to rally, I think it just continues to stay choppy. At the moment, stock indexes are on pretty key support. What's really interesting is last month in November, the biggest effect actually was not in stock indexes, but it was with the dollar and particularly the euro dollar. And the euro dollar is at a really interesting level, so we'll take a look at that. So let's start, in fact, with stock indexes. So if we look at the S&P, which has been by far the biggest market leader, when I look on the daily at the big rally that we have had since August, the fifth low when the Fed pivoted, we seem to be making a very nice 5-wave rally. And within that, I think the start of the 5th wave rally was this 4th of November low. We seem to be in a little bit of, we could draw this as a bit of a rising wedge. And this is quite important because if we break down from this rising wedge, one of the key things in Elliott waves is about parallel channels. For me, the first target is going to be the parallel. We can draw very nicely 3 or 4 touches on the top side of this rally, and I think therefore for me, if we break down here in a bigger breakdown, that the parallel from this top rail, if you like, is going to be our first target, which kind of brings us back to the lows around 5,730, and that also brings us back to the July highs. In fact, there's a pretty clear pivot level here. So this and the kind of bottom of this channel, this parallel channel, if we break down and we start seeing a bigger move, or when this lovely rising wedge that we're in is over, I think that that's likely to be our first port of call to look for support on the downside. For now, though, we're in a really strong uptrend. If we look at just the rally that we've had since November, mid-month November, you know, I always look at this 236 fib as key support. As long as we ride that in terms of fib terms, we're still in an uptrend. We haven't even challenged that from this middle of November low. And when I do this, I always say, right, well, this 236 fib then, 6,050 in this previous swing high. If we get a number that the market doesn't like, I'm looking for that to be support. And if that holds a support on a 4-hour or daily close, we're still going higher, and this lovely little run that we've had since the middle of November is not over. We're still trending higher. If we break underneath this, I think, you know, maybe a bigger pullback to this swing low of these moving averages again. Doesn't mean the party's over. And even if we see a little bit of weakness, I think it still doesn't mean that the top is in. I think that we need to see what happens at the end of the month and the start of January. So that's really kind of how I'm seeing it. If the arse falls out of everything, this 5,700, this really pivot level, would be where I would be looking back to. But at the moment, you know, yesterday it was just a little choppy sideways, and it really wasn't the kind of big breakdown or big top that, if anyone who's looking for that, I'm just not sure that this month is going to be it. For now, we kind of haven't even pulled back as far as key support is. So 6,050 in the S&P futures E-mini is where I would be looking for. And underneath that, I think we see a bigger pullback to that round number 6,000 to the daily 20 moving average, which when we trend is pretty important support. What I would also say when I look at this, you know, it kind of feels like a fifth wave. So at some point, a bigger pullback is going to be due. So, you know, normally in a trending market, you'll make moves like this, and each pullback doesn't come back into the previous pullback swings. But when you get into a kind of fifth wave, it becomes a little bit more choppy and overlapping, and the pullback waves bleed into each other. Makes it much harder to to stay on the trend and ride it. And so at some point when that happens, you know, you look to the previous wave 4 or the previous swing low to be support. So that's why I think that this level down here at 5,700, if it all gets a bit leery, is probably the best place to look for support. And the Nasdaq has been underperforming mainly because of, you know, big tech stocks, and the Nvidia stuff has the big tech stocks have been much weaker than other markets. They have been underperforming, and so the Nasdaq is underperforming at the moment. So the big thing, let's take a look at this euro dollar, because I posted this chart on Twitter. If we look at this on this is a monthly chart of this euro dollar, and we have pulled back to the 50% level of the rally from 2022 to the high that we made in 2023 July, and we've done this with a very interesting equal measured move. That means that if I go down to the weekly here, it means this swing, if I measure from this high to low here like this, is equal to this swing if I measure to this high to low to this 50% point. So for me, that's kind of one of my favorite reversal setups. So I've been watching this 1.04 level for a bullish reversal. Last week, I was looking at this as potentially an inverted head and shoulders pattern. I was looking for a breakout, and unfortunately it was a false breakout, which is always, you know, a pretty strong reversal signal, and that's what we're seeing. So it may be that we need to take our time in December, you know, and FX is no different in terms of trend. You know, quite often in December you'll just seem to see the trend that was the trend going into the month continue into year end, and then if we get a reversal, it will be after that. And so it may be that we have to wait for January and we build a bigger base here in this euro dollar. I'm also now when you have an equal measured move like this back to a big 50% level, then I kind of draw my fibs the other way. So I go from this high and I put them over both swings, high to low. Kind of the first target is usually 50%, but most common retraces are 786. So we should get a pretty decent trade out of this if we can break out of this bottoming pattern that we are building. And if we break down, if we close and hold underneath 104, that kind of negates this pattern and we are headed lower. But because we've got this lovely reaction, not only from this 50% level and this 38.2 level, we had a really nice bounce from this 38.2 fib level here as well. I think we continue in the euro dollar to 102. A lot of people would say, well, what would cause, the dollar to be weaker than the euro? Why would we reverse? And, if you remember last time Trump was in office, he was really keen on weakening the dollar and put a lot of pressure on the Fed to do that for trade reasons. So, yeah, wouldn't be surprised to see that again. Let's take a look at where we are in the pound, because we got a similar thing going on now. If I look at this on a monthly, let's I have to say this is a little bit of a bear for me. Let's take everything off. This is a little bit of a bearish pattern, a trend continuation pattern, potentially in the pound. This is a monthly chart. We're sideways with flat monthly moving averages. So right here in the middle, we really don't have very much of a trend at the moment. And there's an awful lot of uncertainty and new governments everywhere and people not quite sure what the next direction is. So the reason that this is a trend continuation pattern is if I put my fib retraces from the highs in 2021 to the lows in 2022, this first swing was to a 61.8 fib level and we had a nice pullback, and this second swing was to a 786. That is normally a Gartley pattern. I'm just going to take some of the noise off this chart, make it a little bit quieter. So Gartley patterns, of course, were identified in 1922, but Scott Carney, the harmonic trader, he's the guy that put the fib ratios on them, and they do work really well when they work. They don't always work, but if we measure the correct ratio I'm looking for from this pullback, I'm looking for the 1272 fib extension. So if I put this in red, you can see that this lines up. If I make it a different color, so again, from this high to this low, this is the 1272 where it lines up with that 786 fib. So that is why I think this is a pretty nice Gartley pattern if we reverse it. So one of the rules of reversing at a 786 fib is if you hold underneath the 61.8, your first target on the downside is this 38.2, which would be down here at 118. So if we confirm by holding underneath 1.276, our first target is 1.1843, which is a really nice swing for January. If this sets up and we would be underneath those monthly moving averages, we would be underneath this weekly 200 moving average, which is all bunched up here, which is our resistance here on the weekly. And so this is a pretty nice swing trade. Are we likely to roll over this month straight away in December? Probably not, but this is a pretty nice reversal trade that I am looking for. Now this would be dollar strength if this, and this would also mean that potentially we're setting up an interesting reversal in the euro pound as well, and it would mean the pound underperforming. We started to see some pretty nasty employment data in the UK. I'm concerned that we might see some nasty employment data in the US, but in the UK for sure it's coming. So those are the kind of trades I'm looking at. Not dependent on today's CPI. Again, I think that it's going to be choppy and volatile and not much of a trend move until year end, but those are the bigger ones I am looking at. Let me know if there's anything you'd like me to look at.